When starting off your journey in finance and investing, it is extremely important to understand risk and reward, especially with all the emotions involved and the amount of information and opinions available at your fingertips. In this video, we're going to break down the concept of risk and reward, go through a few risk factors you should be aware of, and look at risk appetite so you see what investments are likely to best suit you. Welcome to the Life of Finance. Here we aim to break down the world of finance simply so it's accessible to all. So the concept of risk and reward is that there's a linear relationship between the level of reward you can expect to receive with the risk you take on. The best way we can see this is when we compare the expected returns from savings accounts, from bonds, and the purchase of shares. When we think of a savings account at your bank, we think of safety, or in quotes, a risk-free return. But we are also aware that the return we can expect to get is rather small. Then bonds are considered riskier as you won't have the same security and will need to consider things like default risk or inflation risk when investing, but you will also see a much higher potential return than with your bank. Then shares offer you the best potential returns of the three, but also are much more volatile, having to consider the effects of market sentiments, companies' earnings, among others. Now that I've given a quick overview of risk and return, we're going to look at risk factors and give a few examples as well. When you consider making an investment, you'll need to consider the different risks that may affect that investment. Also note that investments are affected differently by different risks. For example, and to be topical, with inflation at 7%, this is much more damaging to savings than stocks, as more than likely you're effectively going to be losing money with your savings, while stocks have the potential to increase in value, absorbing that excess cash. So now we're going to touch on 4 different risk factors. The first of these we touched on above, and this is an inflation risk. While steady, moderate inflation is good and healthy for an economy, generally, but as you see at the moment, the consumer price index has inflation being around 7%. Also mentioned above, this has a huge detriment on any risk-free based investments or savings accounts. I will show this with the following example. Say for example you have $10,000 in the savings account, the current inflation rate being around 7%, and then the savings rate only being 3%. As you can see here, the interest rate offered doesn't cover the inflation, meaning you're effectively losing money through the loss of purchasing power. Another risk factor you should consider is interest rate risk. This is where interest rates change over the timeline of an investment. This is more of a risk for long-term investments. Probably the clearest way to see the effect of interest rate risk is with variable rate mortgages, where a spike in interest rates could greatly affect an investor's ability to make their interest payments. Another risk factor that should be considered is business failure risk. This will apply to investing in a business, either buying their stock, bonds, or angel investing. This is the risk that the business will collapse or fail. When investing in a company likely to fail, you can see large returns, but this is matched by the chance of you losing your entire investment. This is not really much of a risk for well-run, stable companies. The last risk factor we're going to touch on is market risk. Market risk is considering the impact of the economy, so changes in market sentiment, changes in the business cycle, government intervention, or geopolitical changes. Current examples would be like how the Fed is likely to raise interest rate and reduce their balance sheets, and also an example of a geopolitical threat or risk will be the tensions between Russia and the Ukraine. Market risk is very hard to evaluate, as markets change very quickly and don't always react in the same way to the same news. Moving on from risk factors, we're now going to touch on your risk appetite. When looking at risk and return, it's important to consider your risk appetite. Risk appetite is where you consider your willingness to take risks, the return you need to achieve, and if you're in the position to take such risks. Consider the following to see where you lie. If you purchase a stock and find yourself worried about it, or struggling with stress, then it's likely that investment is above the level of risk that you're willing to take. You'd be best to consider investments with much less volatility, like bonds. Then, if you were looking at early retirement, then you are likely going to need to take greater risks in order to achieve the same return compared to someone that's willing to retire at a normal age. Then, consider if you have dependents. If so, you may not be in the position to take higher risk investments. To finish off this video, the most important thing to consider before investing into anything, you must first understand all the potential risks. Then you can properly understand the potential reward. I hope you found this video helpful. Please leave a comment below if you have any questions. And if you got value from this video, I would ask you to leave a like and subscribe.